Sometime in early 2026, many Bitcoin holders will sell around the $94,000 mark, thinking they've timed the market peak perfectly. They might be making a huge mistake. In this video, I'll show you why that $94,000 level isn't the peak. It's a trap. I'll break down how institutional money may be setting this trap to ignite a second wave rally that most sellers will miss. If you want to understand what the smart money is doing while everyone else panics, subscribe and hit the bell icon. You won't want to miss where this story goes. Let's be real. The dominant feeling in the market right now is fear. Bitcoin is struggling to find its footing after a sharp drawdown from its 2025 highs. As of early January 2026, the price is hovering in the mid-$90,000, but that correction is fresh in everyone's mind. The market feels unstable and risky. For many, the next move seems obvious. Sell, lock in profits, and get out before the real crash happens. This isn't an irrational thought. It's based on patterns that look terrifying on the surface. First is the classic four-year cycle theory. This model has long been the market's heartbeat. A massive run-up, a blow-off top, then a brutal bear market. According to that old playbook, 2026 should be a down year, a crypto winter. Anyone with scars from holding too long has sworn not to make that mistake again, making selling at the first sign of weakness feel like the only sane choice. Second, short-term indicators are flashing yellow. We saw net outflows from spot ETFs late in 2025, cooling derivatives markets, and the fear and greed index dipping into extreme fear. Putting it all together, a painful price drop, negative momentum, and scary headlines, the conclusion feels inevitable. The party's over. Every bone in your body, conditioned by past cycles, is screaming to sell. Selling at $94,000 feels like locking in a win before an 80% crash. You see the price struggling, you see the fear, and you think, not this time. That exact thought is the heart of the trap. You're being led to believe the game is the same one we played before, but the rules have changed. Here's where you separate the old story from the new reality. The fear you're feeling isn't an accident. It could be a feature, not a bug, in a market now influenced by institutional investors. They may be counting on you to sell based on old patterns, while on-chain data shows they are quietly accumulating. Let's break down the fear narrative. First, those ETF outflows. While there were some at the end of 2025, they reversed sharply at the start of 2026. Spot Bitcoin ETFs reportedly absorbed $646 million in net inflows between December 29th and January 2nd. Analysts suggest this was just institutions' tax loss harvesting or rebalancing before buying back in. While you were reacting to last month's headlines, they were buying your Bitcoin at a discount. Second, the four-year cycle isn't dead, but it might be broken. The arrival of spot ETFs from giants like BlackRock created a steady structural demand that never existed before. Bitcoin is being woven into the largest pools of capital on Earth: retirement funds and corporate treasuries. These players don't panic sell on a 20% dip. They accumulate during consolidation. This is why analysts from Standard Chartered and Bernstein are still calling for $150,000 in 2026. They know institutional demand changed the game. Now for the on-chain evidence which cuts through the noise. While retail sentiment is in the gutter, long-term holders have reportedly flipped back to accumulating. The movement of coins from older wallets dropped significantly in early January, a sign that holders are staying put. This is the opposite of a market top, where old coins flood exchanges to be sold. Instead, coins are staying in cold storage, and exchange balances are low, suggesting minimal selling pressure. This period of fear looks like a textbook shakeout designed to make retail sell in panic, allowing patient, institutional money to build positions before the next leg up. So, if selling now is a trap, what's the right move? Recognize that the game has changed. It may no longer be about a single blow-off top, but a multi-phase rally. Here's a possible roadmap for 2026. Phase 1. The Q1 shakeout. We are here. This is the trap in action. The market is consolidating between the mid-$80,000 and mid-$90,000. designed to frustrate investors into selling. The price is pushed to key support levels, making it feel like the floor will collapse. This is psychological warfare. While the mainstream story is bearish, on-chain data suggests institutional accumulation. The smart play may be to view this as manufactured consolidation, not a real top. Keep in mind this is speculative based on trends up to mid-January 2026. Markets can change rapidly. Phase 2. The mid-year reset and rally. Once weak hands are shaken out, the second wave could begin. The price will start grinding higher, breaking out of the consolidation range. This rally will likely be fueled by pent-up demand. The narrative will shift from bearish to bullish, with outlets pointing to renewed ETF inflows and strong on-chain metrics. This is where conviction pays off. Those who held on could see Bitcoin climb toward the $104,000 to $120,000 range. Remember, actual outcomes depend on evolving market factors. Phase 3. The late 2026 blow-off top. This is the rally that early sellers will miss. As Bitcoin breaks its previous all-time highs, real FOMO kicks in. Friends and family who were silent during the shakeout suddenly become Bitcoin experts again. This is where those institutional price targets of $150,000 or even $250,000 come into play. But how do we spot the real top? The signals will be different. Don't just watch the price. Look for extreme euphoria, the fear and greed index pegged at extreme greed for weeks, and a massive spike in old coins moving to exchanges as long-term holders finally take profit. The real top happens when everyone is convinced the price can only go up, a very different environment from today's fear and uncertainty. Of course, these targets are speculative and based on current analyses. Always do your own research as things can shift quickly. The market in early 2026 feels designed to make you think like selling is the smart move. It's a sophisticated trap using past lessons to trick you. The drawdown, the scary headlines, and the bear market talk, it's all noise designed to separate you from your Bitcoin. But the data tells a different story. This doesn't look like the beginning of the end. It looks like a forced consolidation, a calculated shakeout orchestrated by institutional players. They are likely accumulating what retail sells in fear, preparing for a second rally fueled by unprecedented new capital. The choice is yours. You can sell now with the 99%, lock in a profit, and potentially miss the biggest part of the cycle. Or you can learn to read this new market, recognize the trap, and position yourself to ride the wave of institutional capital to the true market top later this year. What's your price target for the real 2026 peak? Let me know in the comments. If this helped you see the market differently, like this video and subscribe for more deep dives into what the smart money is really doing. Thanks for watching.